If you woke up this morning, checked your portfolio, looked at the price of gas, and just wondered how the entire global system seemed to flip upside down over a single weekend, you are in the right place.
Yeah, you really are.
Welcome to the deep dive. We know your time is incredibly valuable, and you're here because you want to cut through that avalanche of panicked headlines.
Right, the information overload.
Exactly. You want to extract the actual mechanisms driving today's reality. And looking at the stack of sources we have for today, Tuesday, March 10th, 2026, the dots we need to connect are vastly different.
Vastly.
I mean, we're looking at a massive 2025 earnings report from the energy giant Saudi Aramco. We have a stack of intelligence and updates detailing the geopolitical fallout of the 2026 Iran war that, well, erupted just days ago.
Just days.
Yeah. And then on the financial side, we're looking at a stock upgrade for the electric vehicle maker Rivian. And finally, and this just happened, an aviation alert about a nationwide JetBlue grounding.
Just hours ago.
Right. So the mission today is to take these seemingly unrelated events and build a cohesive picture of how vulnerable our highly optimized world truly is, both physically and digitally.
But before we begin connecting those dots, there is a ground rule we need to establish for you, the listener.
Yeah, very important.
Because our sources today heavily cover the ongoing 2026 U.S.-Israeli strikes on Iran and the resulting regional war, we must be absolutely clear that this analysis remains strictly impartial.
Completely objective.
Right. We are not taking sides, nor are we endorsing any of the political or military viewpoints contained in these reports. Our sole objective is to impartially report on the factual, economic, financial, and geopolitical impacts exactly as the source material presents them.
Okay, let's unpack this, because to really grasp the sheer whiplash the global economy just experienced, we have to look at the state of the world literally days before this storm hit.
The baseline.
The baseline, exactly. And nothing illustrates that pre-conflict stability quite like Saudi Aramco's full-year 2025 financial results. When you look at these documents, the scale of wealth is just... it's difficult to process.
It really is.
They reported an adjusted net income of $104.7 billion for the year.
Billion. With a B.
Yeah. Just doing the rough math on that means Aramco is generating something like $286 million in pure profit every single day. I mean, how does a single entity even manage that much capital?
It requires an operational scale that very, very few organizations on Earth possess. To understand how they generated that $104.7 billion in profit, you really had to look at their cash flow from operating activities.
Which was, what, $136 billion?
$136.2 billion. They have optimized their extraction and refinement processes to an unprecedented degree, and what they did with that cash is just as important for the global market.
Right, the payouts.
Exactly. They pushed a massive $85.5 billion back out in total shareholder distributions in 2025 alone.
I saw that they declared a base dividend of nearly $21.9 billion just for the fourth quarter. But looking through the analyst notes and references, everyone seems completely fixated on this one metric called the gearing ratio.
Ah, yes, gearing.
The report highlights that their gearing ratio dropped to 3.8% at the end of 2025, down from 4.5% the previous year. Now, for those of us who aren't reading corporate balance sheets every day,
Sure.
what exactly is gearing, and why is a 3.8% ratio such a huge deal?
That is a great question. Think of gearing as a measurement of financial leverage.
Okay.
It essentially asks how much of this company's operations are being funded by debt versus how much is funded by their own equity.
So their own cash versus borrowed cash.
Exactly. If a company has high gearing, they are heavily reliant on borrowed money, and that makes them highly vulnerable to interest rate hikes or sudden market shocks.
Right.
So a gearing ratio of 3.8% is incredibly low. It demonstrates a state of extreme financial health. They have a massive war chest, essentially zero restrictive debt burdens, and total flexibility to move the market however they see fit.
And it looks like they're using that flexibility to actively pivot away from their traditional bread and butter.
Yeah.
I mean, the report highlights their plans to acquire a significant minority interest in a company called Humane.
Right.
And the sources describe Humane as a portfolio company specializing in artificial intelligence. Why is a company that sits on oceans of physical crude oil aggressively trying to unlock AI value creation?
What's fascinating here is that Aramco clearly recognizes that the future of energy extraction and distribution is entirely data-driven.
Interesting.
We aren't just talking about, chatbots here. We are talking about using AI for predictive maintenance on multi-billion-dollar rigs.
Wow.
Or instantly processing complex seismic data to find entirely new reserves. And it is already paying off. Aramco realized $5.3 billion in value from AI, digital, and other tech solutions in 2025 alone.
That's a massive return on investment.
It is. They are modernizing rapidly, which includes progressing their plans to increase their sales gas production capacity by about 80% by 2030.
So it's the ultimate picture of stability and forward-looking growth.
Totally.
But the irony is almost painful. They published this report showing bulletproof financials and a smooth AI-driven transition into the 2030s, and then immediately, literally days later, the geopolitical floor completely falls out from under their exact neighborhood.
Yes.
I'm looking at the timelines compiled in these Wikipedia pages, and the escalation is terrifying. What exactly triggered this total shutdown of the region?
Well, a catalyst occurred just over a week ago, on February 28th. The conflict began with joint U.S.-Israeli strikes, which were codenamed Operation Epic Fury.
Operation Epic Fury.
Right. These operations specifically targeted high-level Iranian leadership and critical military infrastructure. According to the sources, this included the assassination of Iran's supreme leader, Ali Khamenei. And this was utilizing millions of dollars in advanced U.S. military equipment, including stealth aircraft and precision-guided munitions.
And obviously, an action of that absolute magnitude does not happen in a vacuum.
No, it does not.
The sources detail the Iranian retaliation, which immediately shifted this from a localized military strike into a full-blown global economic crisis.
Yeah.
Iran responded by entirely closing the Strait of Hormuz.
Yes.
For anyone listening who hasn't looked at a map of the Middle East recently, can you paint a picture of why this specific piece of water is so critical?
Absolutely. The Strait of Hormuz is the ultimate geographic choke point. It's a narrow waterway connecting the Persian Gulf to the Gulf of Oman and eventually the open ocean.
Okay.
At its absolute narrowest point, it is only 21 miles wide.
21 miles, that's nothing.
To put that in perspective, that is roughly the distance from Manhattan to JFK Airport.
That's incredibly tight.
Right. And into that incredibly tight space, the global economy attempts to push roughly 21 million barrels of oil every single day.
Every day.
Every single day. That represents a full 25% of the world's seaborne oil trade and 20% of the world's liquefied natural gas, or LNG.
Here's where it gets really interesting. On the exact day of the strikes, February 28th, the Iranian Revolutionary Guard Corps, the IRGC, started issuing warnings directly to commercial ships.
Yeah, directly to the captains.
Right. The sources mentioned they were using VHF radio transmissions to tell captains that passage was, quote, not allowed. What does that actually look like on the bridge of an oil tanker?
So VHF stands for Very High Frequency Radio. It's the standard international open-channel communication method used by every single ship on the ocean.
Like a CB radio for ships.
Exactly. Normally, a captain monitors VHF for routine updates.
Yeah.
Maybe another ship announcing a wide turn, or a port authority warning about incoming weather.
Routine stuff.
Very routine. But in this case, commercial captains were sitting on the bridge of tankers carrying hundreds of millions of dollars of highly flammable cargo. And the standard weather channel suddenly lights up, with the IRGC officially confirming the strait's closure and explicitly threatening to set fire to any vessel that attempted to cross.
That is terrifying. But I want to push back on the panic just a bit, though. Surely, in 2026, the global energy market isn't entirely dependent on a 21-mile stretch of water. I see in the notes there are overland alternatives, like the Habshan-Fujairah oil pipeline in the UAE.
Right.
Can't they just bypass the strait by pumping the oil across the land?
That is the logical assumption, and it's what a lot of people think. But this is where the sheer scale of global energy consumption becomes a trap.
How so?
Well, yes, the Habshan-Fujairah pipeline exists, and it strategically bypasses the strait. However, its maximum capacity is around 2 million barrels a day.
Oh.
Remember the number we just discussed? 21 million barrels normally flow through Hormuz.
So the pipeline is a drop in the bucket.
It covers less than 10% of the normal volume. The vast majority of the world's energy infrastructure remains physically trapped. When you forcefully close a valve that size, the pressure backs up instantly across the globe.
And we saw that pressure explode into the energy markets immediately. I mean, Brent crude oil prices spiked violently, jumping from around $70 a barrel to over $110 a barrel in just days.
In days.
And even here in the U.S., where we have a massive domestic production buffer, everyday people felt it instantly. Gasoline prices jumped 5 to 10 cents a gallon daily, pushing the average well over $4, levels we haven't seen since 2023.
And while the oil spike dominates the consumer headlines, the natural gas situation detailed in the sources is arguably much more critical.
Really?
Yes, particularly for the European and Asian markets. European gas prices nearly doubled almost overnight. Now, this wasn't just due to the Strait closing.
Right, there were actual attacks.
It was catalyzed by direct drone strikes on Qatari gas facilities. Specifically, the Ras Laffan complex was hit.
Why is Ras Laffan so important?
It is the world's largest liquefaction facility. It is singularly responsible for 20% of global LNG production.
Wow, one facility.
One facility. And when it was struck, Qatar Energy was forced to declare force majeure and completely halt production.
Force majeure, that is a legal term, right?
Yes.
What does it actually mean in practice for the countries relying on that gas?
Force majeure translates to superior force. It is a standard clause in massive corporate contracts that essentially says an unforeseeable, unavoidable catastrophe has occurred, like a war or an act of God, and therefore we are legally freed from our obligation to deliver the product we promised you.
So the contract is just voided for now.
Exactly. When Qatar Energy invokes that, it means countries that were depending on those shipments to keep their power grids running suddenly have zero legal recourse and zero gas.
That is a nightmare scenario.
It prompted the Qatari energy minister, Saad Sharita Al-Kabi, to issue a very stark warning. He stated clearly that if exports remain halted, it could lead to the literal, quote, collapse of world economies.
And you can see that fear bleeding directly into the financial sector. The Dow Jones dropped over 400 points on March 2.
Yeah.
But honestly, looking at the sources, that feels like a minor paper cut compared to the devastation in the emerging markets. The KOSPI index in South Korea dropped by 12% in a single day.
12%.
Yeah, and the notes say it triggered a circuit breaker. For our listeners who aren't day traders, what happens when a circuit breaker trips?
A circuit breaker is an automatic emergency mechanism built into stock exchanges to prevent a total psychological panic.
Okay.
When an index like the KOSPI drops by a specific, severe percentage, in this case, 8% or more, the exchange's computers literally halt all trading for a set period, usually 20 minutes.
To just force people to cool off?
Exactly. It forces traders to step away from their terminals, take a breath, and stop the algorithmic freefall. The fact that a major Asian index triggered one shows the absolute terror in the market regarding Asian reliance on Middle Eastern energy.
That terror was even worse in Pakistan. Their KSE 100 index experienced its largest single-day decline in history. It lost 16,089 points in hours. That is a 9.57% plunge. Entire swaths of national wealth were just vaporized. And it wasn't just digital wealth that stopped moving. Physical movement in the region ground to a halt.
Completely.
The aviation data shows over 4,000 daily flights were canceled across the UAE, Qatar, Kuwait, and Bahrain.
The logistical paralysis cannot be overstated. We're talking about the grounding of one of the busiest global transit hubs on the planet. Emirates Airlines suspended operations out of Dubai. Qatar Airways was severely disrupted.
I even read about Gulf Air in the notes.
Yes, the sources note that Gulf Air was so highly concerned about their assets being targeted by Iranian strikes that they preemptively evacuated their entire fleet to airports in Saudi Arabia.
Just moving the planes out of the blast zone.
Exactly.
And with a conflict this intense, the shockwaves don't just stay in the Gulf. We are seeing bizarre historical echoes and realignments all over. For instance, the sources highlight a really interesting anomaly regarding global real estate.
Right, the London market.
Analysts are projecting that prime real estate prices in London are about to surge. They're comparing this to the 1973 oil crisis and the 1979 Iranian Revolution, where Middle Eastern capital flooded into overseas property markets. But why London specifically? Why does an oil crisis in the Gulf make mansions in the UK more expensive?
It comes down to the concept of a safe haven asset.
Okay.
When high net worth individuals or royal families in the Middle East see literal drone strikes and airspace closures, their immediate instinct is to move their liquid capital into something tangible and legally protected.
Far away from the conflict.
Far away from the blast radius. And London real estate has historically served this purpose perfectly. It offers a combination of a highly stable legal system, strong property rights, and a market deep enough to absorb billions of dollars quickly without collapsing. It acts as a massive sponge for frightened global capital.
And while capital flees to London, military tensions are bleeding outward. The intelligence notes show Azerbaijan is deploying troops toward the Iranian border.
Fearing a spillover.
Right, fearing that border skirmishes or an internal Iranian collapse could spill over into the Caucasus. Meanwhile, in the eastern Mediterranean, there are growing protests in Cyprus. Cypriot citizens are deeply anxious that the British military bases on their island might be used for offensive operations.
Dragging them into it.
Exactly, dragging them directly into the crossfire.
If we connect this to the bigger picture, this crisis is fundamentally accelerating a shift that was already underway, but for entirely new reasons.
The energy transition.
Exactly. Historically, the push for renewable energy has been framed around environmental and climate goals. But the closure of the Strait of Hormuz is rapidly strengthening the geopolitical case for renewables.
That makes a lot of sense.
Nations are waking up to the fact that relying on global fossil fuel supply chains means your national security is always tied to the stability of a 21-mile waterway halfway across the world. Decentralized power generation, like localized solar and wind, offers a way to escape that hostage situation.
Which brings us perfectly back stateside, where we are seeing investors bet heavily on exactly that kind of localized energy independence. Just as gas prices are breaking $4 a gallon, the electric vehicle manufacturer Rivian received a major stock upgrade.
Yes.
The financial firm TD Cowen upgraded Rivian to a buy rating, giving them a $20 price target. And the timing of this is incredibly specific, Kirk.
Highly specific. This upgrade arrived just 2 days before Rivian is scheduled to officially unveil its new R2 SUV at the SXSW Festival in Austin on March 12th. The R2 is seen as a make-or-break vehicle for the company. It is priced around $45,000, which is significantly cheaper than their flagship R1 models. But the real reason analysts are bullish is that Rivian claims the R2 is fundamentally cheaper to build.
I see the engineering notes mention they achieved this by using, quote, fewer electronic control units and larger castings.
Right.
To be honest, $45,000 is still a massive purchase for the average consumer, especially when they are already feeling the pinch at the grocery store. How does changing the control units make this a better bet for the company and the buyer?
Let's break down those manufacturing terms because they are crucial to understanding the price drop. An electronic control unit, or ECU, is essentially a mini computer that runs a specific part of the car, one for the windows, one for the brakes, one for the battery.
Okay, that makes sense.
Traditional cars have dozens of them, which means miles of heavy, expensive copper wiring connecting them all. By using fewer, more centralized ECUs, Rivian strips out massive amounts of complexity and cost.
And the larger castings.
Similarly, larger castings means instead of welding together 100 different small pieces of metal to make the frame of the car, they use a massive machine to pour molten metal into a single giant mold. It drastically speeds up the assembly line.
Wow.
Analysts project these efficiencies could push Rivian's annual revenue from $5.4 billion in 2025 up to a staggering $16.3 billion by 2028.
Okay, I understand the mechanics of why the company might be more profitable, but let me play devil's advocate here for a second.
Sure.
Is buying a $45,000 EV really a practical reaction for a consumer watching the Middle East burn?
It is less about a direct, immediate reaction and more about a macro-psychological shift in the consumer market.
A shift in mindset.
Precisely. In the context of a closed Strait of Hormuz and $110 a barrel oil, electric vehicles are increasingly viewed as a geopolitical hedge.
Ah, I see.
If you own an EV and have solar panels on your roof, you are completely insulated from a drone strike in Qatar or a war in the Persian Gulf. You have bought consumer-level energy independence. The TD Cowen upgrade reflects Wall Street's realization that this kind of domestic resilience is becoming highly valuable.
But the irony is that in our rush to build this highly optimized, technologically independent future, whether it's Aramco's AI investments or the complex computer architecture of a Rivian, we are creating entirely new blind spots.
We really are.
We try to engineer our way out of physical choke points, and we end up just building digital ones. Which brings us to our final source, an event that happened just hours ago. Today, March 10th, 2026.
Right.
The Federal Aviation Administration issued a nationwide ground stop for all JetBlue Airways flights. What exactly went down?
The details are brief, but incredibly revealing. From 12:35 a.m. to 1:30 a.m. Eastern Time, no new JetBlue aircraft were permitted to depart anywhere in the United States.
A total freeze.
A total freeze. And the request for the halt didn't come from the FAA due to weather. It came directly from JetBlue's own operations center. Preliminary reports indicate it was caused by a widespread internal IT systems outage.
It is baffling to think about. An airline is an incredibly complex, massive physical operation involving thousands of people, huge machines, and intricate logistics. And yet, a glitch in an internal server room somewhere just freezes the entire apparatus nationwide.
This raises an important question, and it is the crucial thread that binds everything we've looked at today. We spent the first half of our analysis discussing how the physical global economy can be instantly paralyzed by the closure of a 21-mile stretch of water in the Middle East.
Right.
The JetBlue incident is the exact same principle, just applied to the digital realm. We have optimized our modern infrastructure to prioritize absolute efficiency over redundancy.
With efficiency over safety nets.
Exactly. Whether it is a physical shipping lane handling 20% of the world's LNG or a centralized IT network managing a nationwide airline, we have built a world defined by massive, hidden, single points of failure.
So what does this all mean? We started today by examining Saudi Aramco, a company sitting on $104 billion in annual profit, desperately pivoting toward an AI-driven future to maintain its edge.
Yeah.
Then we watched the geopolitical stability of their region shatter as the 2026 Iran war closed the Strait of Hormuz, the ultimate physical choke point.
The ultimate bottleneck.
We traced the immediate shockwaves, oil spiking, European gas markets freezing under force majeure, and stock markets from Seoul to Karachi triggering emergency circuit breakers just to stop the bleeding.
Right.
We saw how those ripples sent capital fleeing into London real estate and push Wall Street to upgrade EV manufacturers like Rivian as consumers hunt for ways to insulate themselves from global chaos. And finally, we looked at JetBlue, a stark reminder that even if we escape the vulnerabilities of physical oil, our digital infrastructure is just as fragile.
Which leaves you with one final thought to explore long after this analysis ends.
Let's hear it.
Throughout this entire timeline, the overarching theme is a desperate global rush toward energy transition. Nations and markets want to move away from oil not just to save the environment, but to free themselves from the geopolitical hostage situation of the Middle East.
Right.
But think about the secondary consequences of that freedom. Since the end of World War II, massive global alliances, defense pacts, and the very deployment of the United States Navy have been structured almost entirely around protecting the free flow of fossil fuels through places like the Strait of Hormuz.
That's a great point.
If decentralized renewables, EVs, and AI actually succeed in making nations completely energy independent over the next decade, what happens to those alliances?
So they just fade away.
If the West no longer desperately needs the oil flowing out of the Gulf, does the security umbrella vanish? And what new, unpredictable conflicts fill that vacuum when the old rules of geopolitics no longer apply?
That is a profound perspective and definitely something to keep in mind as we watch these markets continue to react. Thank you for spending your time with us today on this deep dive. Stay curious, keep questioning the systems around you, and we will catch you next time.